They say, yeah, okay, you're right. Not June, July, so they're going to raise in September. Are you kidding me? The September Fed meeting is 5 weeks before the election. Do you think that the Fed wants to walk into the election bus if they cut rates in September after not doing it for over 4 years? 2020 was the last time they cut rates by bliss for the election. They cut rates. That's the last thing the Fed wants. The Fed says we're not political. They're highly political. I'm at work with senior Fed officials and partners with former Fed vice chairs. It's been a lot of times the Fed is a regulatory lawyer. They're highly political. They read the papers as the saying goes. So they're not going to cut in September just for political reasons. They now November, December. If you just look at inflation, you're not going to cut. But if we're in a recession, which we may be, that's a separate topic. You may have to cut because of the recession, because of rising unemployment. But the Fed thinks that can happen. And while she thinks that can't happen, I have news for you. It can happen. It has happened. So what do you call the combination is the Fed's assumptions for unemployment slow, inflation gets high, unemployment goes up, and inflation comes down. That's the Fed's assumption. So they actually don't mind if unemployment goes up a little bit because it'll bring inflation down. But what happens when you have high unemployment and high inflation at the same time, the Fed thinks that can happen. It has happened. It's called stagflation, stagnant growth with inflation prices. I lived through it in the late 1970s, early 1980s. Unemployment was 10%, but interest rates were 15%. Don't tell me unemployment and interest rates move inversely. Sometimes they do. But sometimes they can both go up together. It's called stagflation. And I see early signs of that. So it's a little bit troubling, but all I can say to our viewers is Wall Street always gets this wrong. The Fed always gets it wrong. The reason they get it wrong is because their models don't work. The models are garbage, but the inflation is real, is going to stick around, but growth seems to be slowing. So we may end up in this kind of stagflationary episode. So QE, which doesn't work, they printed $10 trillion. And the economy was flattened down for the 10-year period from 2009 to 2019. So coming out of the global financial crisis in 2009 until COVID, average annual growth in GDP was 2.2%. During the Reagan administration in 1983, 1986, the US economy grew 16% in real terms. That was over 5% a year for 3 straight years. That's growth. That's what the American economy can do. Even though that's not totally sustainable, you should be able to grow 3.25%, 3.5% on a consistent basis. That's what a developed economy should be able to do. So 2.2% is pathetic. I mean, you can get on Tom's if you like, but that's what we have for 10 years. My view is that the US economy has been in a depression since 2007. And people say, well, wait a second, Jim, recession is 2 consecutive quarters of declining GDP. And that is the rule of thumb. It can last 3 quarters, sometimes longer, but they tend to go 6 to 9 months of declining GDP, 2 or 3 quarters. That's the technical definition of a recession. And it is. And so people say, well, depression must be worse than recession. So if recession's 2 quarters, that depression must be 10 quarters of declining GDP. And we have not had that, but that's not the definition of depression. A depression doesn't mean continual declines in GDP. It means below trend growth. It means depressed growth. And it was what I was just saying earlier, if growth potential was 3% and you're growing at 2%, that gap between 3% or 2% over time is trillions of dollars of lost growth. Has the economy been growing? Yes, it grew in 2023 and so far in 2024, but it's depressed growth relative to potential, and that's what a depression is. And if you want an example, just look at Japan. Japan has been in a depression since the late 1990s, December 31st, 1989. And they rang that New Year's Eve bell, and then boom, the stock market fell out of bed, declined 75%. It just got back about a month ago. The Nikkei index just got back to where it was in 1989, which is about 40,000. So now what's going on, guys? It took me 34 years to recover your meltdown. And that's all they've done is recover. And there hasn't been as much since that. Japan has had 9 recessions since 1990. Well, you can chart the recessions, but I caught one long depression. It's a 34-year depression. I was in the US, has been in a depression since 2007. So that's about 17 years. And we got 17 more years to go. But that's why everyone's out of sorts. That's why real incomes are coming up. That's my income distribution, is the rich get richer, as the saying goes. And they do, and everyday Americans are falling behind, and middle class is getting wiped out. You can still look for a technical recession within that time series. Security doesn't work. Government spending deficits. That's fiscal policy. Security is monetary policy. That's what the Fed does. And deficit spending is fiscal policy. And that's what the Congress does. How does QE actually work? Why was the Fed's printing money and Fed's printing money? Well, what's your definition of money? I mean, the Fed has 4 definitions of money. So start there. They have M0, M1, M2, M3. Some people think Bitcoin's money gets to a point pretty quickly for no one really knows what money is. So how does QE actually work? How does the Fed print money if that's what they do? Well, the way they do it, they buy bonds from Wall Street. They call it the primary dealers and they say, offer me 10 units. You offer me 5 units. So as your Goldman Sachs or Citibank, whatever you call it, an author in defense is done, and then the dealer delivers the bonds to the Fed. And the Fed pays for it with money that comes out of thin air. So the Fed gives the money to the dealer to buy the bonds, and that money comes out of thin air. That's N0-based money, printing money. The question is, what's the bank do with the money? The bank just sold the boss to the Fed. They got paid. What do they do with the money? They give it back to the Fed as a deposit, something called excess reserves. And the Fed pays the metrics. They just say, well, you get interest on your bank account. The Fed pays interest. That is called the interest on excess reserves, IVR. All the Fed is doing is building up the balance sheet. The asset side is being gobbled up with bonds, buying bonds, and the liability side is being built up with deposits from the banks, which are liabilities from the Fed's point of view. So you're expanding the balance sheet, but the money's not going anywhere. All the QE money, $10 trillion, never went anywhere. They paid the dealers and the dealers give it back to the Fed. It was sterilized and never did anything. So was the money printing. Yeah, if you're using zero to measure but didn't do anything for the economy, it doesn't stimulate growth. Ben Bernanke was full of it. Jay Powell is a little more honest. Janet Yellen, she's kind of a formative auction dance. They didn't understand any of it, and it definitely did not work. So why is the economy growing? Wright kind of painted a gloomy picture from the supply side, and real income's a lot of those, but the economy is growing. That shows up in GDP. Why is it growing? The answer is fiscal policy, deficit spending. That's completely different than monetary policy. That works because, well, it works in the short run. It can be inflationary, but it works. Because when the government spends money, they're giving it to somebody. The money that the Fed created, they give it to the banks. The banks give it back and destroy the money that the Congress spends, the deficit spending. It's going somewhere. It's buying weapons. It's going to food stamps or welfare or Medicare or Social Security checks. Or the Green New scam where, a lot of this kind of wasted, but it's going out into the economy. People are getting paid. Corporations are getting paid. They're paying their workers. That money actually does create growth. But there's another problem associated with that. So the short answer is monetary policy doesn't work. It's a joke. We follow it. We report on it. But I'll tell you as an analyst, it's a joke. Fiscal policy does work, but at a very high cost. And here it is, US economy. It looks like it's growing about 2.4%, 2.5%, which it's low compared to potential, but it's decent growth. But how much is the debt going up? At the same time, the debt's going up faster, just going up by 3.5% on an annualized basis. So are you running deficits? Yes. Are you getting some both? Yes, but the debt is going faster than the growth. And so this shows up in a measurement called debt-to-GDP. People throw around big numbers, and there are big numbers, $37 trillion of national debt. And that's about right.